saving a trade is the thing that tends to get most people in trouble, right? In other words, I'm going to take on more risk a lot of times in both directions, where it's to the point where it's irresponsible. Like we see these people do this all the time.
Before we get rolling here, just a reminder to please like and share our videos. Your support helps us to continue to bring you the wonderful content that we share with you each and every week.
It's like, and this is where that leads, by the way, right? The mindset of why is it bad? The mindset of saving a trade. It's because you get into these positions where you have this trade on that has, say, $5,000 in structural risk. It has a max loss of $1,000 and say a profit target of $1,000. I get drawn down near my $1,000. I have a choice, right? I can say, well, I'm going to try and save the trade. Well, a lot of times if I try to save the trade, I'm not really taking some sort of a technical view on the market or whatever. If I want to maintain zero delta and I want to save the trade, usually that involves like rolling it back or making a situation where now you have like a lot of volatility risk and you're in the center of this position and the market's been moving a lot. And if it continues down, you're not going to lose 1 times your exit loss trigger. You're going to lose 2, 3, 4 times your exit loss trigger, right? Because we're increasing size. And I guess I can represent this with a strategy that was popular back when I started trading, and that is the iron condor strategy, where if the market goes against you one side of the position, you would take that side off and you would roll it back. The problem with that is the initial condors only had a very small profit margin for the amount of risk they had. So when they rolled it back, if you did that and the price did the normal thing, it would probably get back to break even or maybe a small loss, right? But it would never be profitable. So that's not acceptable, right? We have to make money, at least, in the day. So when we rolled back, we doubled size. So you take your bad side, you roll it back, you double size. Well, now you're in a trade that's bigger. It's near maximum loss. And and it's got more positive delta at this point, which isn't necessarily a bad thing, right? If the market's been down, you kind of want positive delta, but you don't want it with that kind of risk, because now that I'm double sized in that direction, if we have that second down day, now I'm not looking at it at a, right? This is, not understanding your risk or applying appropriate risk reward principles. But now if I have that big down day, now I'm looking at, instead of taking a loss of, my total credit on my initial position, I'm looking at taking a loss of maybe 5 to 7 times my total loss in my total credit on my initial position. And that was great so long as the market was relatively reasonable. But in 2007, when we started heading towards the financial crisis and we're getting these bigger than normal down moves, they were starting to get killed. And the people who survived that by being able to save the trade were not able to save the trade in 2008. And I know at least 3 people that completely blew their accounts and had to go back to work. It's like they retired because they were going to do iron condors for this iron condor trade for the rest of their life, because it had worked for a year or two or a couple of years. And now they have no money left and they have to go back to work because they did something foolish, right? In the sake of probability, right? These were high probability condors. They won most of the time. And they didn't have the discipline to like get out. They were trying to save the trade, right? It's not about saving the trade. It's like, okay, am I in a responsible position given my parameters, or am I not in a responsible position given my parameters? If I'm not in a responsible position given my parameters, then I want to do something else. And like I said, one of those things might be just locking down your structural risk like you've seen us do. And I think that is probably beneficial most of the time. But sometimes it's not. It's like if you look at the play trades, I'm letting those lose to the downside. We're actually in a very good position with this last one, but it's like I had an M3.4U on that the market went down and it stayed down. We ended up locking in a reasonable structural loss, and the market didn't come back, and that's okay, right? I didn't try to force the win. I didn't try to avoid the loss. I didn't. I'm minimizing the loss, right? As far as I'm not minimizing the loss as far as the least possible loss, but I'm minimizing my structural risk so that if I lose, it's reasonable. Okay. And then on the next cycle, the market continued down. I did the same thing. And that was also, well, it's not a loss yet because actually it's a loss as of today. I think the expiration was 417. That's all. That was also a loss. So that's two in a row that we did that on and it lost. I can tell you that 80% of the time when I do that, I'm going to make money. I'm going to get back to normal. I'm going to make money. Sometimes I'm not. I'm okay with that. It's not a big deal. I still did the same thing the third time, and now we're in a very decent profitability with that particular trade. You know, over time doing that method will work out fine, but it's not going to win every time. And had I changed to something else and maybe doing straight bearish at this point, I would have got killed when the market reversed, right? So it's like you're going to have these things and you're going to have these losses, and I need to learn to lose well, right? This is what I mean. I need to learn to lose well. I need to go in with the understanding that, hey, you know, I'm going to do all the right things, and I may do all the right things. I may do them perfectly. I may trade flawlessly. I'm still going to lose. I don't want that to bother me. I want to have my solid discipline practices so that I'm not trying to win trades that are not winnable. I want to be like, is this position appropriate given what's happening? If it's not appropriate, then I want to change it or exit, right? If I'm drawn down too much, I want to have the discipline to just exit and lose well. I want to make sure my risk reward structures are appropriate. Like if I can save a trade, so let's put it this way, right? Let's put this in a different context. If I can save a trade while maintaining appropriate risk reward structures, and I'm willing to lose if things don't play out, and I'm doing it in a disciplined way, then that's perfectly appropriate, right? There's no issues with that. I have no issues with that whatsoever. I think that's perfectly fine. If I'm expecting to win all the time, then I have a problem, right? That's going to be a problem. So I want to avoid that one thing. But a stage 4 action might be understanding, like I have this issue where my trade is drawn down. Rather than like maybe rolling back, I might choose to do something else. And that something else might be the trade lockdown, like we were doing in the examples in the play trade, and then waiting it out. It's not necessarily trying to save the trade. It's just like, well, I'm drawn down this much in my time frame structure. You know, I'm doing this trade in M3.4U, for example. I'm willing to lose. I have exit loss trigger $500 in the time frame. Realistically, I know my realistic loss might be up to 1,000. So I'm willing, like I know that those numbers work in the long term with the probability of the general trade structure. So I'm using that information, and I'm saying I would rather lock down my risk to a level that allows me to stay in the trade and wait for a bounce. If it happens, because I think that there's a probability that it might happen in that time frame. In other words, I've used my money, so I'm not going to enter a new trade and take on another $5,000 risk, right? That's no different than taking on another $5,000 risk in the trade that I have. Let me say that again, right? Taking a trade that has a $5,000 risk number that is supposed to be in a certain time frame, and losing $5,000 and closing it and re-entering a trade and taking on another $5,000 of risk is no different than staying in the trade I am and risking another $5,000. They're both bad trading practices, right? And again, it's a non-subjective. It's a way of trying to avoid a loss or get back at the market, or fear of missing out on gaining, or fear of missing out on a potential win, right? One of the things that I might even put in here is on the magic formula is the understanding that there are always plenty of opportunities to make money in the market. And just because you're out of the market because you hit your risk limit for a couple of weeks, and you might miss out on some gains, is not a reason to take on excessive risk. The amount of risk willing to take is always should be defined, and it should be respected. And that should be not only per trade, but in a particular time frame. It tells you kind of when to get out. The last thing that I have here is completely ignoring profitability for at least a year. Profitability comes. It's like if I joined if I started a football team and my only objective was to win every game, and I never really put them out on the field without ever really being out on the field and experiencing losses, uh, I'm not going to get anywhere, right? It's my focus needs to be on playing well. My focus needs to be on doing the right things. My focus needs to be on having the right discipline. And the problem is that people come in the trading and like I said, they expect it to be easy, and then they expect to be profitable like right away. And if they're not profitable, they think they're doing something wrong and they switch strategies. And this is why I know people who've been trading for 20 or 30 years and still lose money because they never got away from that cycle. They never took the time to ignore the profitability and build the skills needed to be a winning trader. And I encourage you to completely ignore that for at least a year. Like if you do stage 3 and do an M3.4U, you'll probably make money every year. I can't guarantee you that, but chances are you will. And if anything is, if you're maintaining a consistent size and you're entering every trade and you're following the rules and you're getting out when you're supposed to get out, I would say that there's like 95% chance you're going to make money any year you enter the market, any year you do that, which is a really cool thing, right? Because you can make money while you're learning. I can't guarantee you're going to make money, and I certainly know you won't make money every month, and you won't make money every 3 month cycle. But chances are you'll make money for that, and I could say if you do this for 5 years, you'll probably almost definitely make money. Doing that, you're not going to be the most consistently profitable. You're not going to be making the most money, but you'll probably be profitable. And if you're doing that in the process of building your discipline and learning to lose well, and you're focusing on improvement, and then you're just learning to understand price movement as you're going along, and you're learning how risk reward structures work and stuff like that. I mean, that's the goal, right? And those skills allow you to trade well. And then once you can trade well, you can go and you can do really, really well.